My name is Jake, welcome to the channel. In today's video, we're gonna do another Review My Pie video where I review subscriber portfolios. I absolutely love this series. We've been doing this for about a year now, and it's so interesting for me to see how different people, we've had people from New Zealand, from Australia, from, Nepal, all across the globe that have been sending in their portfolio. And it's so interesting for me to see how different people in different environments, different age groups are viewing this topic of dividend growth investing. And I've been reading a lot of your comments that you're feeling the same way. It's so interesting to see how maybe a 20-year-old is investing compared to maybe somebody that's in their 40s or in their 50s. In today's Review My Pie, we're going to take a look at 4 portfolios. The first is going to be from a 25-year-old here in the United States. The second, a 59-year-old here in the US. Then the third is going to be from a 26-year-old from the United Kingdom. And then the fourth, a 31-year-old from the US. As always, everybody, I don't pre-script what I'm going to say in these Review My Pie videos. I don't even look at the portfolios in advance. And as always, the timestamps are in the description below, as well as the portfolio links if you want to check out the individual portfolios that we're reviewing here. And as always, everybody, I'm just a random dude down here in Austin, Texas. Don't take what I'm saying as financial advice. This is just merely for your entertainment. And if you do want to book some one-on-one time with me, I've gotten a lot of you requesting to meet one-on-one, and you have a lot of questions that are really particular to you. I can't offer financial advice, but if you do want me to review your portfolio, or if you want to bounce off investing ideas, you can book one-on-one time with me. There's a link in the description below. Please do keep in mind, I only offer it a few times a week. I have a full-time job. I own 3 rental properties. I'm looking to buy a 4th here this year. So I don't have all the time in the world. I don't do YouTube full-time. Like, I have a lot of stuff going on, but I definitely want to make time for those of you that do want to meet. You'll have the opportunity to do so if you choose. Speaking of being really busy, so for those of you that have been following the channel, my wife and I were expecting our first little baby boy here this next week. So we got that going on. And this week, my computer that I've had for the last 6.5 years just decided to die on me. So that was kind of a roller coaster working with IT support and trying to figure out if it was software or hardware related. Yeah, that was fun. So now I'm rocking on a nice little Dell laptop, recording the video, and I'm hoping that it can work. It was kind of a scare. I was even concerned that I was even going to be able to record a video this week. So thankfully I do have the laptop, but the quality is not nearly as good as my old computer. This whole week I've been trying to figure out if I can save the computer. It is old, it's over 6 years old. I was trying to figure out if it was software or hardware related, and it was kind of a back and forth. It was working, it wasn't working, and then at the end of the day it kind of looked a little like this.
The damage is not too bad. As long as the foundations are still strong, we can rebuild this place. It will become a haven for all peoples and aliens of the universe. Now those foundations are gone, sorry.
So yeah, the computer's pretty much dead. So I'm going to be rocking this, little laptop until I can buy a new computer. So the first portfolio here is from Kristen. Kristen writes, "Hi Jake, I followed your channel for the last couple of months and I've been thinking a lot about my financial future. I've enjoyed watching your channel while considering which stocks and ETFs I want to invest in for early retirement. I'm 25 years old and I plan to retire or work part-time around 50 to 55 years old. I will soon move to Houston to begin a new job, and I plan on eventually owning at least 2 rental properties there for additional income. I have maxed out my Roth IRA for the past 2 years, and I just started my early retirement fund. I plan on investing around $500 per month in this account, and I'd like to eventually live off of my dividends in addition to income from my rental properties. Although I have been investing for a few years now, I'm still thinking over my allocations for this portfolio and would like your feedback. Thanks, Kristen." All right, Kristen, this is so great. So you're 25 years old and you're already thinking about your financial future. This is amazing. You even mentioned that you're looking to get into real estate. I'm down here in Austin, Texas. I love investing into real estate. It's a great way to generate additional cash flow from the rental income. And you're also maxing out your Roth IRA. This is so great. And you're thinking about this from different angles. You're also thinking about transitioning from your growth stocks into dividend stocks 10 to 20 years from now. I really like that, especially if it's in a tax sheltered account like a Roth IRA, because you're not going to be paying taxes on those capital gains when you transition from growth to dividend to income or to dividends, right? So this is absolutely great. Let's take a look at your portfolio. It's called Fire Fund. Love it. You're up over 200% in the last 5 years. This is incredible. This is not even considering the reinvestment of dividends, which you're getting over a 2% starting yield. So a couple of things here. You're crushing the S&P 500 in terms of the performance, but you're also beating the S&P 500 in terms of the dividend. So you're beating the S&P 500, beating the market, if you will, on both fronts. You do have a little bit of an expense ratio, which is not bad. It's actually really, really good. You have 58 holdings, so that's a little bit on the higher end. I'm curious to see what you have in here. So if this is supposed to be a passive portfolio, 58 may be on the higher end. It really depends. A lot of people ask me, Jake, is 50, what's the right amount of stocks? How many holdings should I have in my portfolio? This is probably one of the most common questions that I get when it comes to new investors thinking about building out a portfolio. And the answer is there's no silver bullet. There's no one size fits all answer. It really comes down to your personal preference. If you're in the position, if it's a hobby of yours to follow up on your portfolio, and for some people that's intimidating and they don't want to do that. They want to get maybe 1, 2, 3 ETFs and call it a day. And that's completely fine. There's no right or wrong answer as a whole. It really comes down to your personal preference. And I think, more power to you. And with technology, with M1 Finance and other brokerages like this, where you're getting commission-free trades, you can build out your pies. I think, having 58 holdings is not a crazy amount. But I will say it's not for everyone. And it's okay if it's not for you. And it is okay if you want to have 58. So there you go. That's my long-winded answer to the amount of holdings there. All right, cool. So let's see your allocation. You got 20% to growth technology. You got 20% to dividend ETFs, 12 to financials, 10 to real estate, healthcare, industrials, 8 consumer, telecom, and utilities. Okay, so with your time horizon, I actually really like this. I like that you have utilities lower. I like that you have telecom lower. Consumer, it depends on if it's consumer discretionary or staples. So that really depends on the consumers, but I think this is fine. I think financials may be a little bit on the higher end. It depends on what's in the financial slice. So let's take a look at your first slice here, your growth technology. You got 11 holdings. You got your ARK Innovation ETF. I absolutely love this ETF. Cathie Wood is a genius. I think I'm not a fan of their new ETF that they just came out with, the Space ETF. I think that's a little bit overkill, but I really, really like the ARK Innovation ETF. I really like the Genomic ETF. The VGT is my favorite growth ETF. VGT is what I hold in my Vanguard Roth IRA. It's the largest holding in my Roth IRA. Vanguard. This is my favorite one. So all three of these are great. They make up a large portion of your portfolio. Google is great. Microsoft, Apple, great. Square, yeah, I really like Square. Tesla, I like Tesla. Nvidia, I like it. Etsy, Amazon, every single one of these companies, I think these are great. Now you're going to get obviously a little bit of overlap, right? You got Square and Tesla in the ARK Innovation ETF. I really, really like this slice. And as you can see, the portfolio, the performance is incredible. This is a type of growth portfolio that as you see it go down, you should get excited because you're investing for the next 10 or 20 years. This means you get to increase the amount of shares that you're getting for every dollar that you're spending. So this is really great. Let's take a look at your next slice, dividend ETFs. You got VYM, you got DGRW, SCHD, VOO, and VYMI. Yeah, VYM, this is one of my favorite high dividend ETFs. I really like the Schwab SCHD as well. One that you can maybe consider as well that I really like is DGRO. It's also a really good one. But as it pertains to just the ETFs here, these are all high quality ETFs. DGRW is also really, really good. I like DGRW. It's a little bit different than your traditional dividend ETFs. It's really looking at potential future growth rather than on historical growth. So really good for a 10, it's more of a 20 plus time horizon ETF. But these are great. So with VYM, it's more so for a 10-year or under time horizon. DGRW is more for like a 20 plus time horizon. VOO you can have in any time horizon, in my opinion. And then SCHD is like VYM. Okay, cool. So really, really good. I like it. Financials, let's see what you got in here. You got VFH. Yeah, this is a good ETF. You got Visa, you got JP Morgan, T. Rowe Price, SPGI, and MasterCard. This is really, really good. So this is what I was kind of wondering. I was like, okay, well, if you have 12% in traditional banks, like let's say you had only Bank of America, Wells Fargo, JP Morgan, yeah, they're great banks, but they're not growing nearly as fast as like a PayPal, a Square, these fintechs, or, looking at Visa and MasterCard. But what I really, really like about this slice are these two holdings right here. For your time horizon, T. Rowe Price and SPGI are absolute monsters when it comes to dividend growth. These are great, great companies. Great slice. Let's take a look at your real estate. You got DLR, AMT, Welltower, Crown Castle, Stag, Realty Income. Every single one of these are in my portfolio, in my real estate portfolio. I love them. I love that you have DLR. I like that you got Stag. So you have Stag instead of Prologis. That's completely fine. This is an industrial. These are really, when I look at real estate, when I look at REITs, my favorite REIT sector right now is industrials. I love industrials. With e-commerce growing, with there being a bigger need for industrial space, I see it as a massive growth sector within real estate. So I really, really like it. Realty Income, it's good. You got a monthly payer, another monthly payer. Welltower is good. It's a healthcare REIT. American Tower is good. So you got the most in cell towers. So that's fine. And you have data centers there. I think this is a great, great slice. And you can see, it's up pretty well. Let's take a look at your healthcare. You got Medtronic, you got Stryker. Very, very similar to my portfolio. This is so great. I love that you have Medtronic in here. I love that you have Stryker in here. Johnson & Johnson as well. AbbVie, United Healthcare is also great. And Pfizer is great. And the majority of these, I think with the exception of United Healthcare, I own in my portfolio. I think these are absolutely great. And the thing that I like about this is here you have kind of, your more traditional healthcare companies, but in your growth technology slice here, you have the genomic ETF here. This is really where it's looking at like that nano 3D printing, nanotechnology, where it's really forward looking, where these companies that are in this genomic revolution ETF from Cathie Wood, they're not really focused on their revenue and their earnings right now, but rather in the future. Whereas these healthcare companies, they're more so looking at, what they're doing today, but also their potential growth. And so you have what I'm getting at is you have a very well-balanced portfolio when it comes to current income and potential future growth. And I love that. Let's take a look at your industrials. Industrials, you got Honeywell, great, Caterpillar, Union Pacific, 3M, and Waste Management, love it. Waste Management has been crushing it these last couple of months. Absolutely a growth company. I love it. Every single one of these companies are in my portfolio. I love it. You can see it has a lower starting yield, but you can see it's just they're only going to go up. I think it's amazing. And especially they're high right now, but you wait till this infrastructure bill comes out that they're trying to pass. These are only going to continue to go up, in my opinion, right? Who knows? Nobody has a crystal ball, but I really think that they're set up for success. Consumers, you got a little bit of both. You got discretionary and non-discretionary. You got Disney in here. Okay, great. Procter & Gamble, great. Man, these are all really, really good. And you got Altria Group in here as well. I like Altria Group. I like that you have it lower here. This is more for current income. Walmart is great. Do you have Costco as well? Costco as well. These are so great. The thing that I love, Kristen, what I love about your portfolio is these are great brands. These are companies that you know, right? You probably purchase Procter & Gamble products. You maybe are purchasing Lay's, potato chips, right? You maybe have went to Walmart or you got a Starbucks coffee. You know these brands. And that's what I love about this slice and your portfolio as a whole for the most part. A lot of these companies that you're investing in, yeah, there's 58, but a lot of these companies you know and you recognize even as a consumer. So I really, really like this. Let's take a look at your telecom. You got Comcast, AT&T, Verizon, and you got Vodafone. Okay, Vodafone. When I was in Germany, I used to use the Vodafone network. Okay, very cool. I like that you have Comcast at the highest. I think that's a good call. Okay, great. Let's look at your last slice in utilities. All right, in utilities, you got Nextera Energy, Duke, American Waterworks, and Southern Company. These are all really, really great utilities. You know what's great about these utilities? You got Nextera Energy and Duke and Southern Company, which are really focusing more so on the renewables, getting net zero carbon emissions by 2050, if I'm not mistaken. So these are all really, really great companies. I really like how you have the target allocation with Nextera Energy at the highest. I think these are absolutely great. Kristen, I absolutely love your portfolio. It's almost got me a little bit jealous. You know, it has got the performance, it's got the yield, it has the potential to continue to grow. I really like the fact that it's focused on a flexible approach, right? The types of companies that you have in here, some of them are established, like a Walmart, a Procter & Gamble, but you also have growth in here that you can leverage, as you mentioned, 20 years from now, where you can transition out of growth into value and pay zero capital gains tax, assuming that this is in a Roth IRA. I think your portfolio is great. I can tell that you put a lot of thought into setting up your portfolio, and it definitely shows. Thank you so much for sending over your portfolio. All right, the next portfolio here is from Richard. He writes, I hope the day finds you and your family happy, safe, and healthy, and one day closer to retirement. Thank you so much, Richard. I'm 59 and plan on retiring in the next 3 to 8 years, although I have about 800K in various accounts, and being 59, all the investment sites yell at me regularly to rebalance out of aggressive into bonds, to which I say, humbug. I love it. I agree. But I do need a plan. Amon and Christina over at Our Rich Journey first turned me to the idea of dividend growth investing. I have no idea why I have not heard of that before, but having heard of it, I dove headfirst into researching it and planning. I absolutely love Amon and Christina. Their story is so incredible. If you follow the FIRE movement, Amon and Christina are just amazing when it comes to that. So you continue writing here. I had one 401k from a previous employer that I rolled over into an IRA at Schwab. I have another 401k from another employer that I rolled over into an IRA about 2 years ago that I transferred to Schwab. Together they are about 265k, of which I plan to keep 15% as cash to buy into market dips, crashes. Okay. I have another rollover IRA with Fidelity worth around 500k that I will probably keep there for now. Okay, so you have a lot of different accounts. I actually like this. I like the fact that you have multiple accounts. I plan to select which stocks I wanted to say to come to 40 stocks, so you're dividing the amount by 40, okay, and invest that equally across all positions. But then I started watching your channel and the concept of portfolio dividend into sector slices, which stock slices in the sectors, and the concept that you could then apply various weightings to each stock, each sector, and slice, and I thought that made a lot more sense. Absolutely. I agree. Especially if you want to automate this, it's kind of a hassle if you're doing it in manually. So I definitely agree with you. You continue writing here. So I created an M1 account, transferred $300 to play with, and created a portfolio. I didn't like the result, and so I opened an IRA with them as well, and with the idea of transferring the 265 to it and create another portfolio, which I like a lot better. I wanted to get your opinion on it before transferring in the money. All right, so let's take a look at your details. Details are you got 265,000 to play with. Initially, you got the 800,000 in total. You want to retire in the next 3 to 8 years in Portugal, where I can live on 20 to 25K easily. Want to live off of dividend income plus Social Security and not touch the principal. This is great. So you're actually trying to do looking to do what Amon and Christina are doing in Portugal. Okay, an unrelated question, but perhaps an idea for a video. How does all this play into turning, with the 70 and having to take required minimum distributions, RMD. Okay, yeah, no, this is a lot of great stuff. Okay, so first off, you could easily live off of 800K today to get to 20 to 25K. Like, you could set up your portfolio in a way where it's safely, for the most part, generating 20 to 25K today. Like, you don't have to wait 3 to 8 years. You can make it happen tomorrow if you wanted to. So that's throwing that out there. But I love the goal. I love the fact that you're looking at different approaches and looking at different ways to do this with different brokerages. So the important thing here is, if you know your time horizon is 3 to 8 years to live in Portugal, you want to focus on kind of more on the value side, more on current income. A lot of the audience following the channel, they may be in their 20s or early 30s. They want to focus more on growth because they want to leverage the power of compounding to their advantage. Whereas when you're looking to retire in the next 3 to 8 years, you're kind of in the bucket where my wife and I are at, where we're looking for a healthy 3.5% to 4.5% current dividend yield. So that's kind of where we're at. When it comes to the RMD, the required minimum distributions at 70, a pretty simple solution there, in my opinion. You could roll it over into a Roth IRA. But that's something that's more of like an accountant question. I can't really give you advice there. But in my opinion, if I was in the situation or in the scenario, I would roll it over into a Roth IRA. That's what I personally would do. Let's take a look at your portfolio. You got your dividend growth Roth IRA. So this is in a Roth IRA. You're up 66%, very low expense ratio, really nice dividend yield of just under 4.5%, and you have 54 holdings. So you got quite a bit of holdings. 54 is a good amount. Coming back to what I said about this earlier, it really just depends on your personal preference. If you want 50, if you want 10, whatever. The dividend yield is good. So if you're looking to retire in 3 to 8 years, a 4+% dividend yield is spot on. That is where I really like it. So let's take a look at these. You got 11 slices. You got real estate, financials, energy, all the way down to consumer discretionary healthcare. So what do you got in real estate? In real estate, you got a really good, healthy dividend. You got MPW, you got good. All right, I like this. I got WPC, Realty Income, Healthcare Trust, Iron Mountain, and AGNC. Okay, I think these are fine. The only one that I really am kind of cautious about is AGNC. I am personally not a big fan of AGNC because this is a different type of real estate investment trust. This is a mortgage REIT. This is not a REIT that is invested into physical buildings or structures or land. This is invested into the mortgage. And so that's why I'm not a big fan of it. It pays a high dividend, but me personally, I prefer to invest into physical real estate and not into mortgages. They're just so sensitive to interest rates and everything. It's just personal preference. But the others I think are fine. I also like, for a healthy, steady dividend, I really like public storage units. Those are really good. You could look at the one that we just saw earlier was STAG, ticker symbol STAG, really good industrial REIT, pays a monthly dividend. Also for healthcare, if you're looking into monthly dividend payers for healthcare, I like ticker symbol LTC. It's a good healthcare REIT. All right, let's take a look at your financials. You got really high dividend for financials. Wow. So you got Prospect Capital, you got Main Street, you got Citigroup, JP Morgan, and Bank of America. Yeah, I think this is fine. I like, I think Main Street is fine. Citigroup, you got some, traditional banks in here. I think that's fine. You got Energy at 15. You got Exxon, National Fuel, BP, and Devon. Okay. I personally like Chevron, but I think my personal favorites are Chevron and ExxonMobil. I do have to say I'm not as familiar with the financials and the balance sheets of these other energy companies. So I can't really give a solid opinion on the others because I just haven't researched them as much. But as it stands, I like that you have ExxonMobil at the highest of the group here. So you got consumer staples at 15. You got Altria Group, you got Pepsi, Procter & Gamble, and Coca-Cola. I think this is great. A few others that you could take a look at that I personally really like. I like Kimberly-Clark. I think they're currently trading at a discount, but regardless of that, I think it's a great company. I also like Philip Morris. Philip Morris has a 5.5% dividend yield. It's another tobacco company. It's focused on international. I know that, it's a kind of a sensitive topic in terms of, sin stocks, whether people enjoy to invest into them or not. Leaving that aside, just focusing on the quality of the dividend and the company, not what they do necessarily, I think could be something that you could take a look at, given you already have Altria Group. So let's take a look at your dividend ETFs. You got VYM, SCHD, Noble. I personally do not like Noble in here. I don't like Noble. Noble has a high expense ratio and it has a low dividend yield. You want the dividend today. Noble is great if you have like 15, 20 years and it has a high expense ratio. I personally do not like Noble for your time horizon. And especially where you have it at 20%, I'm not a big fan of that. VYM International, I think is fine. VNQ is fine. VIG and IDV, yeah, they're okay. I mean, the question is like, 3%, it's such a small percentage. I don't know. But definitely, in my opinion, Noble is too high given your strategy here. I like VYM and I like SEHD at the highest there. I also like VNQ. Another one that I really like in a Roth IRA is ticker symbol SDYD from Spider. It's a high dividend. The last time I checked, it was right around 5%. The reason why I like it in a Roth IRA is because it also has real estate in it. So it's taxed a little bit differently, but because it's in a Roth IRA, you're not paying any taxes anyways, and that's why I like it in a Roth IRA. So me personally, I would replace Noble, or maybe don't want to replace it, but lower it, and I would include SDYD. Just my opinion there. All right, now let's take a look at your utilities. Your utilities only 5%. I think you may want to consider bumping this up a little bit. Let's take a look. So you got NextEra Energy, Southern Company, and Duke. Yeah, NextEra Energy is a great one, but here, take a look at this. NextEra Energy is not even at 2%. This is like the S&P 500, right? What you want, if you want to live off of the dividends and never sell your shares, look at this. Look at this baby. Over 4%. Southern Company is a great company. It's a great utility. They're also focused on renewable energy. The same with Duke, right? 4%. In my opinion, if your time horizon is 3 to 8 years, like these two should be much higher, and NextEra Energy should be at 5 or 10%, in my opinion. Let's take a look. What do you got here? And also, I would increase this up. Like I would bump up utility, financials. You got higher financials. I would bump up utilities though, personally. That's just I think utilities would be good to be higher. Now let's take a look at your telecom. In telecom, you got AT&T, Verizon, and Shaw. Yeah, I think that's fine. Yeah, that's fine. Let's see what you got in technology. You got Qualcomm, Broadcom, Microsoft, Apple, Visa, and Tesla. Yeah, okay. You could also look at Intel. Intel is not a bad one. You could look at Texas Instruments. They're a really good dividend technology company. Some people really like Cisco as well. Cisco, yeah, I think it's fine. 5% here, I think you're okay. Industrials, you got Lockheed Martin, 3M, UPS, Waste Management, Union Pacific, and Caterpillar. I think this is really good. I like that you have these three higher. I think these three are great. And you have these ones in here as well, but they're lower. I think the allocation for your time horizon is spot on. Okay, what do you got here in discretionary? You got Target, Home Depot, Lowe's, and McDonald's. Absolutely fine. Okay, cool. So when it comes to your time horizon, I think your dividend yield is absolutely great. There was a few things that we were talking about. I think with your ETFs, like we were talked about with Noble, as a whole here, you really want to focus on the dividend yield. Let me show you something here really quick. This is the dividend reinvestment calculator I've shared a few times on the channel. This is a calculator that's going to calculate all of your dividends if you were to retire today. And so, for example, if you had just your $800,000 in here, and let's say your portfolio on an average was appreciating about 5%, dividend growth rate of about 5%, I think that's conservative. I think that's fine. So you have a current yield of 4%, and you're not reinvesting the dividends, and you're not adding additional capital. So let's take a look at it. If you were to never reinvest your dividends, and if you were never to add additional capital to your portfolio, with $800,000 with your current portfolio, you'd be getting just around $32,000 in dividend income in year one. If you never reinvested the dividends, you never added additional capital, in 10 years, you'd be getting just under $50,000. That is what we call dividend growth investing. The dividends are still growing in the background, and the dividend is compounding. And that's absolutely amazing, right? So you said that you wanted to retire in Portugal off of $25,000, and in all honesty, you're already 59. You could do that today. You wouldn't have to wait 3 to 8 years. With your portfolio today and the amount that you would have invested, you could make this a reality today. You wouldn't have to wait 3 to 8 years because the portfolio that you have would already be generating the desired outcome or the desired amount of cash flow. So this is really the interesting part of it. I would encourage you to take a look at this deeper, and I'll leave a link to this calculator. I share it for free. You don't have to pay anything. I'll leave a link in the description below to this calculator. I hope that this was helpful. The next portfolio is from Ben. Ben writes, my name is Ben and I'm 26 from the UK, and my goal is to live off of dividends in the next 20 to 30 years. I'm trying to invest about £80 a month into this pie and 20 into the ETF total market growth pie for when I am older. And then this is my dividend pie and your growth pie. Okay, well, cool, Ben. Let's take a look at both of your portfolios. So let's take a look at your first portfolio. It looks like you're using Trading 212. This is a brokerage that is offered in many other countries outside of the US. And I've heard from many people that it's similar to M1 Finance. So if you're outside of the US and you're looking to invest with a similar brokerage, I guess you can say, where you can create pies, Trading 212 may be a portfolio or a brokerage for you. Once again, I've never used it, so I can't really speak from personal experience. Your long-term ETF pie here, it uses different symbols. So you're in the UK, so the symbols, I don't recognize the symbols, obviously, but I recognize the names for the most part. Your first is just an S&P 500 ETF. So this would be like the US equivalent would be VOO. You got QQQ as well. I think these are absolutely fine. You also got All World at 15%. You also have the Vanguard Financial Stock Exchange 250. Oh, the UK version. Okay, very cool. You have emerging markets and you have Japan. Yeah, I think this is fine. I think, if you're outside of the US, getting exposure to the US is important because it's it's the largest economy in the world, obviously, but getting exposure to other markets, other international markets is, as an international investor is definitely important. And I really like this. I think this is fine. All right, let's take a look at your dividend growth slice. Here you got 27 holdings. You got the Wisdom Tree Global Quality Dividend Growth here at 15%. Okay, you got Walt Disney, you got Microsoft, you got Apple, Pepsi, Visa, Verizon, you got American Tower, Comcast, JP Morgan, Home Depot, Costco. So really some established companies. You even got Prologis. Very, very cool. If you've been following the channel, you always know that I always talk about Prologis. Really, really great REIT, industrial REIT. Johnson & Johnson, Procter & Gamble, McDonald's, the Vanguard All World High Dividend. Okay, interesting. I'm not familiar with the ticker there. Kimberly-Clark, Nike, SPX. I'm not familiar with SPX. Croda International, Spectris. You got Coca-Cola, Unilever, and Derwent London. Okay, so there are some really, really great companies in here, and it's more focused on growth, right? You got Visa in here, you got Microsoft, Disney, you have Comcast, you have Comcast instead of AT&T. So this is definitely focused more on growth. You got Costco, great retailer. You got Johnson & Johnson, you got McDonald's, you got Nike. So you got a balance of current income, right? You got Kimberly-Clark down there, which is more focused on current yield. It's not growing nearly as fast as, Disney or Visa. So you have a good balance in here, and I like that. I think the most important thing here when you're building a portfolio like this and you're international is that you focus on companies that you understand. You understand the brand. You want to optimize for tax efficiency. And I think, every country has different tax laws, right? For example, as a US citizen, if I invest into a UK company or a company based out of the Netherlands, there could be potential taxes. The UK, there's an advantage, but when it comes to REITs, it's a little bit different. So every country has its own laws when it comes to the taxes. I think that's something that's really not talked a lot about, and that should definitely be on someone's mind if you're investing international. But yeah, as it stands, I like the portfolio. I think you've got some great brands in here, great companies, and the way that you have it allocated, you don't have one company making up more than 5% of your overall portfolio. I like it. Thank you so much for sending over your portfolio. All right, let's take a look at the last portfolio from Sandra. Sandra writes, hey Jake, my name is Sandra. I've been binge watching your Review My Pie playlist, and I have really enjoyed your take on different portfolios. I started a Roth IRA with Fidelity as of January 2020. Unfortunately, I had to stop my physical contributions due to the pandemic throughout 2020, along with many other delays. Anyways, I'm currently 31 years of age. My contributions are done manually and not automatically. Okay. As of January 2021, my contributions averaged $244 for that month. I'm keeping my Roth IRA very simple and ETF based. Your current holdings are Noble, IJR, DGRO, SPHD, SPYD, and FDEWX. You continue writing here, ideally I'd want the percentage to be from greatest to least, and the order of ETFs would be DGRO, SPHD, because it's my monthly payer, okay. Noble, SPYD, IJR is kicking butt in growth, which was unintentional, okay. FDEWX, and what else do you got here? As you can tell, this is geared towards dividend growth using ETFs. I'm looking at my portfolio to either help pay for expenses in retirement or pay for everything. Okay, almost forgot, I have all my investments on a DRIP. DRIP, for those of you that are maybe unfamiliar, DRIP is Dividend Reinvestment Plan. Okay, so you're automatically reinvesting the dividends. With M1 Finance, it does it automatically for you into your portfolio. With other brokerages, it does it into the company or ETF that paid the dividend. So you're at 22, so just under 23%, return for the last year as of the beginning of 2021. In the near future, I do plan on starting a taxable account, just not sure what to have in it yet. I'd love your take on my very simple portfolio, Sandra. All right, so this is really cool. So I think, so in most cases, simpler the better, right? A lot of times we think overcomplicating things or over-engineering things will make our returns better. And in most cases, for your average person, that's not always the case. I think keeping it simple is usually the best approach for your average person that maybe is not, spending half of their day researching investments. So I think the simple approach is really the best approach for most people. All right, so we're going to take a look at two things. We're going to first take a look at the ETFs that you have in your portfolio here on the email, and then we're going to talk about different types of companies or ETFs that you could ideally hold in a taxable account. Because what we're looking at here is all in a tax sheltered account in a Roth IRA. So with the Roth IRA, you're not getting any tax advantage up front. You're paying the taxes on the money that you're putting into the portfolio, but after you reach 59 and a half, you're going to pay zero taxes on the distributions, the dividends, or if you sell anything, you'll pay zero capital gains tax. All right, so let's take a look at your first holdings here in DGRO. I really like DGRO as an ETF. I own it in my portfolio. It's a great growth ETF. It's a dividend growth ETF. The reason why I like it is it's really more focused on technology, but you also have that current dividend of about 2.5%. And I really think it's a well-balanced, growth-oriented or focused ETF. SPHD is fine. I think SPHD is not the best out there, but it's also definitely not the worst. It has a higher expense ratio. The companies that are held in SPHD are not really growing as fast as the ones in DGRO. So they're very, very different. And so if we're talking about a Roth IRA, you have the next, almost 30 years ahead of you. It may make sense to focus more on growth because SPHD is focused like as if you were to retire in the next couple of years. So that's the difference. And because the power of compounding is so impactful, you want to focus, especially in a tax sheltered account, you want to focus on growth. And that's, obviously just my opinion, but I think if you were to look at this and just look at the math, you would more likely be better off in terms of the total return in having something more in a growth ETF like your IJR or DGRO. This is the small cap ETF. Because you have so long before you're going to access the portfolio, it may make more sense to increase this instead of SCHD. And you could always change that down the road, right? You could always, adjust this in 10 years. But right now, obviously with IJR, it's small cap. It's going to be much more volatile. It's going to go up a lot. It's going to go down a lot. But over time, over the next 20 years, it's going to outpace an ETF like SPHD and also Noble. So that's something to think about. SPYD is also really great. I just talked about it here a minute ago with Richard, but Richard is in a very different scenario, right? Richard is retiring in the next 3 years. So he wants an investment that is higher yielding. It's not growing as fast, but it's yielding a higher dividend. And that is so key. That's why we talk about dividend growth, because really that's the question. When are we going to need the money? And given your circumstance, in terms of the total return, you or anyone in your circumstance, in your age group with that long of a time horizon would, in most cases, be better off focusing on growth. That's something to consider as a whole, as the ETFs themselves. I think they're great ETFs. The allocation, I would maybe reconsider a little bit on how you want to have the allocation set up. So that's something to think about. And this is a target date fund. I've shared another video on target date funds. You can check that out on the channel. Target date funds are not bad, but I think I'd recommend checking out that video. It might shed a little bit more light on it. So that's my opinion on it. I think having DJRO up there at the top is great, but I would also consider maybe taking a look at IJR, or even maybe the S&P 500, right? VOO. I think you're going to get a better return with a VOO than, for example, with FDEWX or SPYD over the next 20 to 30 years. And Sandra, another thing that I would also recommend you do is go to my channel and take a look at this video right here. It's called the Dividend Starter Pack, How to Invest Based Off of Your Time Horizon. If you have 10 years, 20 years, 30 years, or 40 years, this video is going to give you a lot of insight on what to look for when you're investing based off of your time horizon. I think you and a lot of people watching the channel right now will get a lot of value out of this video, because this walks through exactly what I look for based off of different investing time horizons. And then the next thing that you asked here is on starting a taxable account. When you're investing into a taxable account, I think it's important to focus on or understand the tax implications of how your dividends are taxed. You have non-qualified and qualified. You want to focus on qualified dividends in a taxable account as much as possible. And so if you're unsure of what that means, I would recommend, first researching and understanding the different tax implications of dividends. I shared a video almost over a year ago, one of the first videos on my channel, on how are dividends taxed, qualified, non-qualified, and international. You can take a look at that video. Really, essentially what I look for is, understanding my time horizon. When am I looking to live off of the dividend? But in most cases, you're going to be better off focusing on the growth if you have a longer time horizon, say 20 or 30 years. So I hope that that's helpful. And also when you're constructing your portfolio, I really like that you're keeping it simple. Don't try to over-engineer it or overcomplicate it. If you don't understand what these ETFs are, for example, you may be even better off just sticking with the S&P 500. There's really it's very difficult for an ETF to even outperform the S&P 500 or the total stock market, right? The total US stock market in ticker symbol VTI from Vanguard. I'm a huge fan of it. I own a part of that in my Roth IRA. In my Roth IRA, I keep it very simple, similar to you. I hold a handful of ETFs. I own the Vanguard VGT ETF, as well as the total stock market VTI, and also the international ticker symbol VXUS. And I also have a real estate REIT ETF in there in VNQ. So I keep it also very, very simple. And I think focusing on ETFs is very beneficial, especially if you're new to investing, because then from there you can grow. And as you feel more comfortable in your investing strategy and your emotions, because investing is very emotional, then you can branch out into other investments if you so choose. But as a whole, I think you're doing all the right things. You're educating yourself. You're trying to inform yourself on investing. And I would just say, keep doing what you're doing. Thank you so much, everybody, for watching the video. These next couple of weeks are going to be kind of crazy for my wife and I. With the baby coming here, I'm going to do my very best to record a video every single week. Thank you again for watching, and I'll catch you in the next video.
You know what? I think we're going to be friends. Can everyone say hi to my friend? That's crazy. I just wanted to say thanks. I'm glad you came along, partner.